Hi, everyone. This is Jason Burek of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. He's been getting more well-known now with his recent interview on Blockworks Macro. I found him many years ago, I think 2017 or 18 over on Real Vision. He had amazing insights on the Chinese economy, the Chinese banking system, the Chinese real estate market. He was actually way ahead of the curve. He was predicting this years in advance. He's the chief strategist at Macro Lens. Brian McCarthy, thank you for joining me again.
Yeah, thanks for having me.
So, Brian, we're recording this interview on Tuesday, February 13th, 2024. The dollar index has rallied substantially. It's up to 104.88. The 10-year U.S. Treasury yield, it's been a roller coaster the last 6 to 8 months. It's back up to 4.3% because I guess the market's not getting the rate cuts yet. I want to get your thoughts on macro before we get into China. Does something big have to break before the Fed starts any rate cuts, in your opinion?
I think that's a fascinating question. It's a little more difficult to answer as we sit here on the evening of Feb 13th after a 0.4 print on the core CPI, which has thrown the rates market into a tizzy today. I think the dynamic, as I read the tea leaves of the Fed rhetoric and various comments from various corners of the FOMC, and even going back to December and digesting the last couple of press conferences of Jay Powell, I think he's trying, he wants to pivot. And I think his plan at December, which he had probably gotten loose sign off for, was to, start the talk about a pivot to normalizing rates as inflation falls. I think they had targeted May all along because, as of December, they still had a very slight bearish tilt in the statement. They were still talking about, what might justify further rate hikes. And then we saw in January, they took out the reference to further rate hikes and they went to sort of a balanced risk approach, we used to call it. And then I think March was slated to talk about the possibility of a cut. And then they would take the statement in March and tweak it towards an easing bias. And then by the time they eased in May, everybody would have known for 2 months that it was happening. So I think that was his plan in December. This is not to suggest that the Fed is overtly political. However, if Jay Powell puts the economy into recession in the summer of an election year and gets Donald Trump elected, he's not going to be welcome at any cocktail parties. They might kick him out of his country club or something. Let's just say, that's really not something he wants to get pegged for doing in terms of his legacy or his standing in DC. And you know what? It's just bad form anyway, because the fact of the matter is, in my view, there's ample evidence that monetary policy has been effective. And this is somewhat of a controversial statement at this point. If you look at, I know you're on fairly active on Twitter. I'd say the consensus in that, FinTwit community or FinX or whatever they call it now, is that rate hikes have been ineffective or less effective. And I think we need to unpack that because while it does seem to be the case that this economy had a big nominal head of steam in 2021. We did come out of the pandemic with a couple things that have elongated the cycle. Okay, one being the excess savings, which by some estimates are still there a little bit, but be less and less a factor as each day goes on. And the other factor that elongated this cycle was that we had this disruption of the labor market that has taken, frankly, much longer than I would have thought to resolve itself, namely in healthcare and government jobs, which have been the driver of employment growth in 2023. So we did have this elongated cycle. But when you want to assess whether Fed policy is effective, I think you need to have a firm sense of what Fed policy does. The Federal Reserve controls nominal variables. They don't have any control over when a healthcare worker who was freaked out about COVID decides it's safe to go back to work. right? That's not something they control with interest rates.
Yeah.
What they control is nominal quantities. And here's why I say monetary policy has been effective. While you look, if you look casually at the economic data, you would say 2023 was a lot stronger than 2022. However, personal consumption expenditure in 2022 was up 9.1% nominal over 2021. 2023 personal consumption expenditure was up 6.3% nominal over 2022. So growth in aggregate spending by all metrics decelerated markedly between 2022 and 2023. But Brian, what are you talking about? The economy was clearly stronger in 2023. Yes, in real terms it was, which was an almost like unheard of, amazing, wonderful experience. Consumers' growth in aggregate spending slowed, but the real volume of goods and services they got accelerated. And that is right out of the textbooks, positive supply shock. I mean, it's literally what happens when the supply curve moves up. So I think what happened was 2022, February, we got the Ukraine shock. We had, oh my God, Europe's going to run out of natural gas. Energy markets went haywire. And we were still dealing with the aftermath of the pandemic and impaired labor markets. 2023, the Ukraine, while the war is still going on, the world sort of learned how to live with it, and that shock has dissipated. Okay, we had continued, maybe even accelerated healing of the U.S. labor market as people returned to work in leisure, hospitality, healthcare, and government, which were the three most heavily impacted pandemic labor forces. And I think there might be a third positive supply shock going on, which is hard to find in the data because I'm not quite sure to what extent this is measured. But I think maybe all of this immigration, legal and otherwise, is probably expanding the labor force in a supply positive fashion. Okay, the Fed doesn't control these supply side variables. They control the nominal variables, and the nominal variables are slowing. Now, here's the problem. If the Fed continues to put downward pressure on nominal growth, and these positive supply influences fade, in other words, the same number of people don't come back to work in healthcare, they keep coming back, but at a slower rate, then that supply shock is sort of going to run out of gas, and you're just going to have lower nominal growth, and we're going to have like more problems like we saw at New York Community Bank. So this is an extraordinarily confusing time in macro, because again, nominal growth slowing, real growth accelerating. I mean, I'd have to pour through the data to see if that's like ever happened on a full year basis. It's extremely unique.
Do you think that the Fed rate hikes have caused a worse wealth disparity and then also more of a bifurcated economy? So let me just give you an example. So if you're an SEC accredited investor, let's say you have a couple $1 million in savings, you're making a couple $100,000 or more, you can go and take advantage of those higher interest rates with the Fed rate hikes, and you can earn 4.5. Well, I think it's over 4.5% now for short-term treasuries. You can earn that in interest. But if you're making a lot less, let's say, than a couple $100,000 a year, you're now exposed with the Fed rate hikes, because everything is priced off the 10 years treasury at higher cost of capital. You're now exposed to much higher interest rates on credit cards, auto loans, mortgages if you didn't lock in a 30-year mortgage, those types of things. Do you think that has created a bifurcated economy then in the real economy in the U.S.?
Well, I think it's just a mathematical fact that whenever the Fed pushes interest rates higher, those with floating rate liabilities get hurt, and those with floating rate assets benefit. It's that simple. I mean, there's no two ways around that. I'm not really sure that ultimately that's a driver of wealth disparities persistently. because ultimately that stuff, the wealth distribution is a real side variable. I know people criticize the Fed for the Fed put and backstopping markets, and I do think they've unwittingly gotten themselves into that business with this obsession over financial conditions, which I'm not a fan of. So when they're focused on financial conditions and markets puke, and they come in and save the day with rate cuts and QE. It's very, very tricky because they're not supposed to sit there and let the market collapse into a deflationary spiral either, right? That's Congress didn't establish the institution to sit there in March of 2020 and sit there with their thumb up their ass while the government shuts down the economy. So they're sort of stuck, and it's really their institutional mandate to come in and cut off that left-hand tail. But then they talk about it and couch it in this financial conditions, and it's very easy to see that as they're giving the market a put. So in a way they've created a problem for themselves, in terms of perception in that regard. But in the long run, wealth distribution is primarily a real economic variable. It's gonna be due to real factors, and some of those factors might be fair, might be God-given talent or education and hard work, and some of those factors might be unfair. It might be that people have certain connections, or people can lobby the government for certain regulations that favor them and hurt their competitors. That all happens too. But I'm not sure monetary policy is really the place to look first and foremost in terms of income inequality. And again, when they raise rates, it's just the way it is, right? If you have fixed rate liabilities, you're not hurt. If your liabilities are floating, you are.
So the people then who haven't locked in a 30-year mortgage, they didn't buy a house 7 or 8 years ago and lock in or refinance their mortgage or lock in a 30-year fixed rate, who don't have a lot of credit card debt. I mean, they're doing pretty well right now if they had savings and they can.
Jason, let me be clear. I think one of the reasons that there's a fairly widespread, there are a couple reasons for the widespread disillusionment with the state of the economy, and the fact that the people at Bloomberg News and the Wall Street Journal keep scratching their head as to why Bidenomics isn't more popular. One is that real wages since 2019 really haven't done anything, right? And that's really the crux of the problem. So inflation always hurts those lower on the income scale disproportionately. Okay, if food and energy and other necessities are a large portion of your, you spend a lot of your discretionary income on that, and real wages don't rise, it's very, very, very painful. Okay. The other thing is, absolutely, when you get a big monetary inflation, and home prices go up, I don't know, by some metrics by a third or more. And it really screws renters at the expense of homeowners, okay? Because a homeowner sees their equity increase. A renter just sees their rent increase. So if you had a home, or better yet, two, that was, a great way to protect yourself through the pandemic, as it is a way to protect yourself through every inflation, right? Real estate, real assets. And, I know you're into gold and all that stuff, right? The real assets like real estate and gold are what you want when there's a big monetary inflation. So if you want to pin inequality on the Fed, it's not the tightening. It was the overcooking the QE and accommodating the Treasury's $5 to $6 trillion helicopter drop by QE. When, with in perfect hindsight, instead of accommodating that, the Fed would have been offsetting it to some extent, and we wouldn't have had a double-digit inflation rate, and home prices increased by a third or whatever you want to call it. So you've sort of led me here in a way. I do think you're right that monetary instability can exacerbate income inequality, but it's the inflation. It's the inflation, and again, you were protected if you owned a home, and if you didn't, your rent might have gone up by 40-50% in the last 40 years, and your wages are up by 10 or something, which is why we have the Wall Street Journal and others in recent weeks bemoaning the fact, rightly so, that young people in their 20s are spending more as a proportion of their income on rent than like ever before. And it's really made the economics of living in a larger, in some cases even medium-sized city, untenable for young people today, and let alone trying to buy a house at these rates. So undoubtedly, the monetary instability of the last couple of years has been destabilizing. I think you're right on that.
Yeah, we're in agreement. I think really the rules changed a lot post 2008 financial crisis. I would say the Fed and DC decided they weren't going to allow deflation and asset prices to stay low for long. And there was intentional zero interest rate policy and Fed balance sheet expansion, quantitative easing, or 2019, it was not QE. They said it wasn't quantitative easing, even though the Fed's balance sheet expanded by $1 trillion in only a couple months in 2019. And so I would say that the policy since 2008, they decided they didn't want to allow deflation, especially for asset prices. But like you said, they allowed this to go on for way too long, and this created asset price bubbles.
Well, here's the problem, right? The Fed is there to avoid another Great Depression. I mean that's. They're not going to make that mistake again. And actually, you can't allow deflation because deflation is self-reinforcing. A debt deflation, and this is, we can segue to China in a little bit. There's no equilibrium in that direction. It's self-reinforcing to infinity. It's a black hole.
Well, especially with the amount of credit and how a lot of the assets are held by leverage. Here's
the problem. And we're seeing it now. And we saw it in 2008. So preventing the deflation in 2008, 2009, in my view, was not the mistake. The mistake was allowing the inflation in 2003 to 2007. Right? They completely basically lost control of the monetary creation process, through the magic creation of these AAA assets and the leverage that it facilitated. Some of the Eurodollar stuff that I know Jeff Snyder sort of became famous for. They didn't have any control or insight really, or sufficient insight into that process. So the mistake was 2003, 2007. And I think in this case, the mistake was 2021 primarily. But once these bubbles blow up, they have to come in. But now you can see there's a little more, they seem to give themselves more degrees of freedom to make mistakes in the inflationary direction than in the deflationary direction, which means that we'll have these periods where, inflation's stable and the price level's rising by 2%, and then it'll jump and it'll never come back. So, you remember when the heck was it? Was it 2019? They went to average inflation targeting. That was their program for about 3 months.
I thought the 2% above target, they've been doing that since 2010. I mean, I would argue that the monetary policy by the Fed has been loosened from 2010 to 2018, 2019. That was the last Fed rate hiking cycle. Then it broke a bunch of stuff, and then they panicked.
I would dispute that. The proof is in the pudding. And I think it might have been Friedman who say, you can't judge the stance of monetary policy by looking at the level of interest rates. you have to assess it by looking at the level of interest rates, what relative to the neutral or equilibrium interest rate. The problem is you can't see that. So whether monetary policy is loose or tight, that assessment in real time is by nature highly uncertain. But we can look at results, and if you look at that 2010 to 2019 period, it was the slowest nominal growth of any cycle in the post-war period, and it had the slowest rate of bank credit extension of any cycle in the post-war period. And core PCE averaged around 1.6 against a 2% target. So we had a good 8-9 year stretch there where you look back at the results and you say slow nominal growth, slow bank credit, below target inflation. You can't really come to the conclusion that the stance of policy was easy. But now you say, wow, they had zero interest rates. The neutral rate had to be negative or very low or close to zero. Now, of course, the big question now is the real neutral rate still 50 basis points-ish, as the Fed estimates, or is it 250 basis points? I lean more towards the former camp because, again, I still see all of these nominal indicators I monitor decelerating. But I was head faked by this big, positive supply shock last year. And you know what? I can't completely discount the possibility that we're having some productivity revolution led by AI that's going to bring real potential growth from, call it 1.5 to 3.5, and bring up the neutral rate by 200 basis points. I don't believe that. I'm not betting that way. It doesn't seem likely to me, but I can't be 100% certain that that's not what's going on. But one more thing about the policy stance. I look at so we call it the business cycle. Everybody's saying we can't go into slowdown because income growth is high and consumption is okay. Okay, those are laggards. What turns down ahead of recession is investment. Consumption generally is healthy until the moment the recession starts. So you can't look at healthy consumption and rule out that we're on the cusp of recession. It's called the business cycle. Okay, interest rates. Yeah, if you have a fixed mortgage, the interest rates don't hurt your household balance sheet. Well, that's great. It's been that way for 100 years. I mean, there's nothing new about that most American mortgages are fixed. Now, we had a long period of fixed rates. So, maybe there's sort of more fixity at low rates because it was an elongated cycle. But we've always had fixed rate mortgages. This is nothing new. This is not how the business cycle works. It's not called the consumption cycle. It's called the business cycle because it works by you raise the interest rate, you raise the hurdle rate to new investment. So if you go back to the Wicksell origination of the neutral rate hypothesis, and if rates are above neutral, you'll have deflation, and rates are below neutral, you'll have inflation. It was predicated on the interest rates effect on investment. Because if interest rates are lower than the equilibrium, there's like an arbitrage condition, people will invest. And investment is demand for resources, just like consumption, except instead of eating it, you build something with it, right? So investment overcooks aggregate demand, and you get an overheating. But if you look at the business cycle, it begins with businesses, and it is all rolling over. Investment in the GDP, including investment in intellectual property products, is rolling over. Housing had a big downturn in 2022, and it was flat in 2023. Okay, so it was a positive contributor to GDP because it stopped falling, but we're still at levels of 2017, 2018 in terms of real estate investment in GDP, and as well as business fixed investment. The only thing that held up investment last year was the 90-odd billion that they spent in breaking ground on manufacturing of semiconductor facilities, which was goosed by the what the hell? The name's escaping me.
Chips Act.
The Chips Act. Yes. Thank you. Right. So outside of that 90 billion from subsidies would be in, close to a investment recession, which is how recessions start. So it is a really, really weird cycle. I know a lot of people are in this reacceleration camp and thinking, the Fed shouldn't be cutting rates. But the bottom line is, if we had a positive supply shock, then they let that derail them from normalizing rates, and then the supply shock runs out, it's going to be like it'll be Wile E. Coyote over the cliff.
Do you see a scenario, and this would be really weird and distorted, where quantitative tightening is publicly announced that it's ending, and the Fed basically does a 180, announces they're going to start buying U.S. Treasuries to expand its balance sheet, but they don't cut rates stay elevated? Do you see a scenario like that happening?
No, I totally believe them when they say they see this running in the background. So the whole quantitative easing, the whole what is monetary, what is money printing, all of these arguments, it's really difficult to even define what printing money is these days, because the Fed pays interest on reserves. So, by my definition, money is non-interest bearing government debt of zero maturity. Okay, so that $20 bill in your pocket pays no interest. Bank reserves pay 5.40, 5.4% right now. So what does a large balance sheet mean when interest on reserves is zero versus when interest on reserves is 5.4%? It means something different for sure. And again, is 5.4% above neutral, in which case banks will be more than happy to sit on that money, or is 5.4% below neutral, in which case banks will feel like those reserves are a hot potato and they'll want to move them around. And to get back to whether the Fed is easy or tight, bank credit is contracting for like the only time in the half a century outside of 08, 09. So it's hard for me to look at banks being unwilling to, basically expand the M2 by expanding their balance sheet and say monetary policy is easy. That to me is sort of a telltale sign it's not easy. But the whole QE thing, again, with interest on reserves, it's really, really, really tricky. And so the interest on reserves itself is a sterilizing mechanism. So, when you sterilize the reserves, that they become, sterile, impotent, not relevant.
So for listeners out there, you mean that the banks don't loan it into the economy? They're not allowing consumer loans or small business loans. They're just parking the cash there to earn interest.
That's right. That's right. By raising the rate at which you remunerate these banks, you pay them to just sit on that money. And that's what sterilization is, right? Like if they cut rates by 500 basis points tomorrow, banks would go start buying assets or making loans like there's no tomorrow, right? Because they were like, now you're paying me zero. I can make a better return elsewhere. If they put it to 10%, bank credit would completely collapse, because why am I making a loan to anybody when the Fed's paying me 10%, right? So, the trick for the Fed is to put that rate at the level where they motivate the banks to make, to extend just the right amount of credit to hit the inflation target. But, easier said than done. It's all a very, very imperfect science. And there's other things going on, namely things on the supply side. There are, real factors that affect the growth rate that they don't really control either. So, it's very tricky. But the QE thing, the Fed says it's sort of running in the background. And because I think that interest rate on reserves is higher than neutral, I agree with them that it's not really terribly relevant. And yes, they're not taking duration out of the market, but like for the most part, they're not really selling bonds. they're just sitting on their portfolio, and it gets 1 day older every day. And, so every day the duration of the portfolio shrinks by, I think mathematically a little less than 1 day, but that's really all they're doing. So I think the market puts more focus on this. It's of more importance in the market narrative than it actually is to the Fed, or that they see it as being important economically. And again, I sort of agree with them.
So I want to transition now to China and the problems with the real estate market, the banks, and also flight capital. For our listeners out there who are not familiar, there was a recent Financial Times article that was interviewing some Chinese investors and fund managers, talking about how they've lost faith in Chinese real estate and Chinese stocks, talking about looking at U.S. asset markets and physical gold demand, things like that. Do you think that a strong dollar in the Fed's policy, is a strong dollar really hurting the Chinese economy right now?
I'm going to give you a long-winded answer. The short-winded answer is yes, absolutely. But I love that we're segueing from the Fed to China, because I'm sort of pigeonholed as a China expert. But to give your listeners a little bit of my background, I spent my entire career in developed markets. I managed a global government bond fund for AIG. I was on the sell side in FX sales, doing both DM and EM, but primarily, DM stuff. And then I was hired by the hedge fund Emerging Sovereign Group in 2011 as a G7 macro strategist. And 2012, my boss said, we don't really do anything in China macro wise, go to China for a month and check it out and tell me what you think. And I came back and I said, oh my God, this is the craziest thing I've ever seen. It's effectively an economic Ponzi scheme in that, investment is, call it 45% of GDP. And because they are a centrally planned system and the investment is increasingly inefficient, okay, particularly once they built world-class infrastructure, continuing to build world-class infrastructure more than you need is negative ROI. So it was readily apparent a decade ago that this is a system that if they don't continue to invest more money at decreasing ROIs, the whole thing's going to blow up, which is a classic Ponzi scheme. But because I came at it from a developed market perspective, I was immediately able to see that the pressure relief valve and the whole thing for China and the mechanism where it will ultimately break down is the exchange rate. And I think I ended up running a fund at Emerging Sovereign Group called the Nexus Fund, and it was based on China having to devalue. It was insanely levered. We basically had the entire fund invested in 1 to 2 year calls on dollar CNH. August 11, 2015, the fund was up a little over 70% on the day. So, that's the kind of leverage we had in the trade. It was predicated on something called the impossible trinity, which is from the Mundell-Fleming framework. And it's just a very basic arbitrage condition of international capital flows, which says that if you're a sovereign central bank, you have a triangle, you can get 2 out of the 3 points around the triangle. You can have there's a fixed exchange rate, independent monetary policy, and open capital account. You can only have 2, not 3. Okay, if your capital account is open and you try to fix the exchange rate, well, then you can't control monetary policy independently because you'll create an arbitrage condition and capital will flow and correct it. So in the presence, in the real world, it goes from a trilemma to a dilemma because you can't really close the capital account unless you're North Korea. Like if you want to trade with the rest of the world, and this is the dilemma China has, if you want to trade with the rest of the world, controlling those capital flows is really, really hard. And then it comes down to question, do you want to fix the exchange rate or do you want to have independent monetary policy? And China has never been able to make this decision. So in 2015, the dollar strengthened a lot. China was feeling a ton of pressure, and they said, we want independent monetary policy. Enough of this exchange rate pegging monkey business. Let's try to float the exchange rate. And because they had been pegging it, and because their entire system is always in a state of disequilibrium, as soon as you introduce market forces, the thing wants to move a lot. And so they said, shit, we can't do that. We're stuck. And this is why China still has short rates at 2.25%, despite the fact that the real estate market is collapsing. Why haven't they gone to ZIRP? Because they're stuck by still sort of half-ass managing the exchange rate. Like they do a little, like they're sort of managing the exchange rate. They're trying to get independent monetary policy, but they can't. And they try to close the capital account, but that's really hard. And like Jesus, 2015 is over 8 years ago now. And like they should have just stuck with it then and gotten out of this jail, but they didn't.
Well,
they are still dealing with this jail. But to get to the crux of your question, all of this has to be viewed in the context of what the dollar is doing, because the exchange rate is the thing that limits their ability to ease monetary policy and address the housing bust. And every exchange rate has two sides. So if they're managing their exchange rate and the dollar is strong, they can't ease monetary policy, they're in a real bad pickle. However, if the Fed was to if Powell says, hey, I don't want my legacy to be a recession, Kashkari, Bowman, I don't care what you think, I'm cutting rates, we're cutting hard this summer, and the dollar index comes off by 10%, China's going to rally like crazy. It's going to rally like crazy because the dollar comes off, global commodity prices rise, PPI in China goes from -3 to +2, and the whole problem looks less urgent. Okay? So if, on the other hand, the dollar strengthens from here, it's really going to tip China over. So I think China's vulnerabilities are such that it's the whole situation is highly, highly levered to the dollar right now.
Yeah, I agree. I don't know the exact number of dollar-denominated debt they have inside China, but it's way more than a lot of the public estimates. I've been speaking to Kyle Bass about this and Emma Mollman, some of the other China experts besides yourself. I've been listening to your interviews, obviously, for a long time as well. And pretty much the consensus is that really since 2008, 2009, China played a bunch of games to you had Jim Chanos and a lot of the other famous shorts that were way ahead in shorting, but then China announced with the stimulus package for extra fixed asset infrastructure investment, they spent 40% of their GDP from 2008 to 2013, some insane number. And then, like you said, in 2015, I think there was a bunch of potential bank failures coming with the currency problems too, and those banks were bailed out to buy time. And then the rubber really hit the road by 2019. They were in a lot of problems again with a lot of the small and regional banks, and they were just they rolled up a lot of the banks' bailouts then too. So I don't know how much longer China could keep doing that, especially with the strong dollar.
So here's why this time might be different. China was able to stimulate in 2009 with their famous $4 trillion stimulus. It was orders of magnitude bigger than that in terms. That was just the direct fiscal. The credit expansion was, I think, the annual year-on-year credit growth hit almost 40% at one point. So there was a huge burst of credit. But why were they able to do that? Because the Fed was re-liquefying the global system by going to ZIRP and initiating QE. Okay. 2012, 2013, Fed did QE again. So we had a big balance sheet expansion, and the ECB turned tail. Draghi said, whatever, I'll do whatever it takes. And the Fed went into QE. So China had a global liquidity tailwind to execute their stimulus. 2016, when did Chinese stocks bottom? When did the pressure come off the RMB? It actually had nothing to do with anything China did. They threw every piece of spaghetti against the wall they could in 2015 to stabilize that equity market. Do you know when it bounced? When Janet Yellen went to Shanghai in February 2016, and China basically scared the pants off her, and she realized, oh my God, we're dotted to 4 hikes in 2016. If we do that, we're going to blow this place up. And she came back and canceled the dots. And risk rallied. So in each of these cases, China has gotten out of their lockbox by primarily the Fed. So is it going to happen again? I don't think preemptively. Like but around every corner, and so this is what ultimately bit me in the ass in 2016, frankly, with the fund I was managing, because our call was that China needs to get out of this investment-led growth model. This is crazy. It's obviously going to end badly. They're talking about reforming. The third plenum in 2012, Xi Jinping told us the market was going to take the decisive role in capital allocation, which I don't think people realized at the time was complete bullshit. People sort of believed that he wanted to do that. And it was abundantly clear to me that, like, well, they can't change the system, break the moral hazard, let the market make the investment decisions. It's everything, all the money they've lent, it's all bad. It's going to blow up. So you're going to need to devalue, and you're going to need to ease monetary policy dramatically to accommodate this like reform process. And that's what they wanted to do in 2015. I think they had the right intention. We need to ease monetary policy to fix this system. So we need to break the exchange rate link. And they spent $1.5 trillion trying to prop up the exchange rate, realized it was failing, and they just went back to fixity. But again, they did get bailed out by this big Fed easing. So what I didn't really see around the corner that China already at that point, like if the Fed ever tightens, China's going to blow up. But the around the corner reflexivity was actually China's now so big that the threat of them blowing up will prevent the Fed from ever tightening.
Do you think?
And so that's what happened in 2015, 2016. And now, again, the Fed is very tight. It's like deja vu all over again. The Fed is really tight. China is in a wicked pickle. Is the Fed going to ease preemptively, or are they going to be behind the curve as the economy slows? Is like, let's say, for argument's sake, New York Community Bank is the canary in the coal mine, and that we actually are looking at a significant commercial real estate problem. I'm not making this argument. I'm just saying, let's just pretend that that's what's going on, and that my assessment that the Fed is tight is correct. The supply, shocks dissipate, and we're in a recession with like a credit cycle by Q2. That's then we're in when we're right in the 2016 scenario again. China will be imploding in that scenario. And then, if you want to think it through, is the Fed reluctant to ease really aggressively at that point because they're then 3-4 months ahead of an election? Could be exciting. I can envision a scenario where it's very, very messy, and this interplay between the U.S. and China, is sort of at center stage again.
So it sounds like China's still dependent on the dollar. I don't know the exact number of dollar-denominated debt inside the Chinese economy, their banking system, shadow banking, the real estate developers, how much they borrow in dollar-denominated debt. I know it's trillions of dollars. And then, like you also described, that they use the dollar, their U.S. dollars and foreign exchange reserves from trade surpluses to defend their currency exchange rate. Do you think that China can easily transition away from the dollar, like the narrative that's going around with petro yuan and some type of BRICS currency? I don't know what it would look like, maybe a basket of emerging market currencies, BRICS, similar to the special drawing right? Or do you think that China has built up the last 10, 15 years a larger addiction and dependence on dollar-denominated debt and dollars?
I don't know that I would characterize it as any kind of addiction to the dollar. They certainly would love to establish, an alternative trading bloc with Saudi Arabia, Russia, some of their neighbors, some Latin American countries, African countries, where they could. And I think they are making progress, and I think they can be successful in setting up the piping to transact should they end up in a bipolar world where they can't use dollars. So, and I think it's in the interest of their trading partners, even in our hemisphere, um, I, I think, let's say Brazil, for instance, which is not in our hemisphere, but I think it's in everyone's interest on China's sort of side of this potential breach to be able to transact in RMB. So look at Brazil. They don't want the US to tell them they can't trade with China. Look at India. India actually can't allow the US to tell them they can't trade with China. India told us to go stuff it when we told them they couldn't trade with Russia. So, like the African countries they don't want to be in a position where the US can tell them they can't trade with China. So it's in everyone's interest to not have that black cloud hanging over them and to find some ways to be able to transact in RMB if push comes to shove. And if you have a large enough block, it's the same problem. It's the same problem anybody's going to have trading with China, is that they insist on running surpluses. So ultimately, the counterparts are going to have to hold RMB assets, and this is where the problem arises. This is the crux of the whole problem, is that China in the last 3 months has reverted almost to completely fixing against the dollar. So the idea that they're moving away from the dollar is really absurd. They're fixing to it, right? Because that system is predicated on the government preventing market equilibrium from establishing itself, and it's been doing it for decades. So what the equilibrium exchange rate, dollar CNY right now, I don't know, 12, 15, who the hell knows, right? So if they were to let it go to 15, I'm sure, African nations and Brazil and everybody else would say, I don't really mind holding some RMB assets right now. But when everybody knows it's at an off-market rate and that black cloud is hanging over the RMB, no, I don't want to hold your assets because you've been maintaining your currency at an off-market rate. Let it trade to a market rate, and I'll hold your assets. So they're really in but the whole, I'm going to say they're in a pickle, and the answer to every question you give me is they're in a pickle, and that's not just my default.
So no good options.
The way the system works, right? All they do is stick fingers in the dike. They try to prevent markets from doing things that they don't want done, and it just creates more and more pressure in every dimension.
Is this why the Chinese people in the Financial Times article, they don't have faith in the People's Bank of China and Chinese government for policy decisions, and why they say they don't trust Chinese real estate, Chinese banks, Chinese stock market right now, because they see the potential for problems. All the scenarios to them look bad, and they are worried about a currency devaluation in Chinese yuan. So that's why we're seeing potentially flight capital into like Bitcoin, US stocks, Mag 7, NVIDIA, and then the physical gold prices. I think the premiums for a couple months now, they're still above 10% of spot prices in Shanghai. Is it flight capital related?
Yeah. If I were a Chinese domestic, I'd want to get anything non-RMB I could get my hands on, whether it was a ball of copper wire or a gold bar or Bitcoin or anything else. And if you look at the stock market in China, they had a big crash in 09, as everyone did, but 07, 06, 07, that market rallied 500% and it round tripped. 2013, 14, it rallied 160% and then it round tripped. This sell-off isn't retracing a bubble rally. This sell-off, I think, is more pernicious and it should be more frightening for Chinese leadership. Because it comes also with, I think, the collapse of credibility of domestic real estate as an asset. I think they have a very serious credibility problem now because Xi Jinping has, I think, very firmly committed to getting off the investment-led growth model because it's a dead end. They're just wasting resources at this point, and he's the leader for life. He's got no one to kick that can to. And he has better uses for those resources because he's got this big agenda for China to be a global power. So, I think it made all the sense in the world for him to end the investment-led growth model. It had to end eventually.
Even though
but
they're wasteful, weren't they kind of jobs like Belt Road Initiative too? Because they sent a lot of Chinese workers to those countries. Weren't those like jobs programs though? So yeah, they were wasteful, but they also put a lot of Chinese men that would have been unemployed to work.
yeah, absolutely. But I mean, you can, it's like the old Milton Friedman story where he was he was on a trip and he saw a bunch of guys with shovels digging something in a field, and he's like, what are they doing? And they're like, oh, I don't know, they're building a new highway or something. And he said, well, why don't they use like bulldozers? And they said, oh, it's for the jobs. And he said, well, if it's a jobs program, why don't you give them spoons?
Yeah, we're back to then Keynesian ditch digging about the ridiculous economics theory, the broken window fallacy.
Right. So I think it just had to stop. And Xi Jinping actually has been signaling that this is not going to be easy, right? The market's been thinking for 18 months, like, oh, unemployment's going to rise. He can't have that. He's going to have to stimulate. He doesn't care if unemployment goes to 12, 15%. And he's basically said, toughen up. These young people lying flat, don't have jobs. Go back to the countryside, get your hands dirty. It's what I did. This is the kind of thing he says. So, I think they had to get off the investment-led growth model, but they've got really no plan for resolving the bad assets. And it's just the problem is this: the resources are gone. It's gone. These aren't just like financial losses. It's Chinese households worked their ass off, and they got paid, and they took a small portion of that pay and they consumed it, and the rest they stuck it in the bank, and those bank deposits are assets that are funding liabilities that are bridges to nowhere, empty apartment buildings, empty cities, the third airport in a medium-sized city. The assets are all crap. So, the actual resources that the Chinese households poured into the system were wasted. They're gone. You can't, the steel and cement and labor that went into the bridge nobody's using, you can't get it back. You cannot get it back. So, there's, I think, if I had to guess, and we can only guess what's in Xi Jinping's head, is he's underestimated the reckoning. He's underestimated how inefficient all that previous investment was, and underestimated how ugly this is going to be if the Ponzi scheme ever, if the money flowing into the front end of the Ponzi scheme ever slows down, which is why they're still growing credit at 10% a year. Okay, credit in China, let's use some round numbers, it's about 50 trillion, and it's going to have to go to 55 this year just to hold things together, just to keep it from collapsing.
How much of that is dollar denominated debt? Do you have an estimate?
Oh, it's all domestic. It's all RMB. It's all RMB. The problem isn't really dollar denominated debt. The problem is, so long as they insist on maintaining the fiction that the RMB is worth 7.2 to the dollar, then they can't ease monetary policy, and they're just going to continue in this debt deflation spiral, and the stock market's just not going to find a bottom, and the real estate market's not going to find a bottom, and private sector demand for credit is going to shrivel up to nothing because real rates, interest rates are going to be 5 and inflation's going to be -2, and everybody's like, screw that. And then the only credit is going to state-owned enterprises, so the ROI and the return falls even faster, and it's a doom loop. It's a doom loop. So again, the only way they get out of this doom loop, even temporarily, is that the Fed eases like crazy, and then so if the Fed were to cut rates to 2% tomorrow, a 7.20 exchange rate wouldn't be as tight for China as it is with the Fed at 5.40. It's just it's this basic arbitrage condition, and it all goes back to the fact that in 2015 they understood that they needed to break this link. They tried, and they didn't like what the result was going to be. which was going to be a very messy devaluation to 9, 10, or 11, or wherever the hell it would have settled. And they just couldn't stomach it. And instead, they put the straitjacket back on. And now it's 8 years later, and the pressure is exponentially more extreme.
That's interesting what you said about how there's not really any significant dollar denominated debt inside China. I mean, I've spoken with Emma Moment and Kyle Bass, and they tell me there's like trillions, and a lot of it's hidden in local government financing vehicles and the Chinese banks. So the European banks and the Eurodollar system were letting them borrow trillions of dollars. That Kyle Bass actually told me 6 months ago. He said the Japanese banks had about $2 trillion of dollar denominated debt inside the Chinese economy too. He told me that directly a couple months ago.
I like who does he think is making these loans?
I mean, I didn't get into all the specifics of it, but it sounds like maybe SoftBank was pledging some of their Chinese tech stocks as collateral on the Japanese bank. So they were loaning stuff back and forth off collateral, off high valuations. SoftBank is involved in a lot of shenanigans. We're seeing that right now with NVIDIA and some of the other AI shares. I want to ask you as we wrap up, though. So I've heard in the recent interview from Blockworks Macro, you talk about Chinese tech stocks. Do you think that there's a lot of value traps in the Chinese stock market? Because I'm hearing a lot of value investors talk about with the crash in the Chinese stock market that there's good value there. Do you trust their accounting? Do you think that there actually is good value for a lot of these companies, or do you think there's a lot of red flags?
I actually do. I'm not like a single name equity guy. I will tell you. I mean, one of the equity investors, a client of mine that I think I have more respect for than anybody in the market, thinks like Alibaba is like his favorite stock. They are really, really cheap. I think the so-called war on tech wasn't really a war on tech. They just wanted to bring tech into the central planning fold. So they had two industries that were allowed to run on a market basis. One was real estate, which went insane. That's not going to happen again. Okay, so the amount of real estate activity will soon enough just be centrally planned. They'll tell whoever ends up remaining, a couple dozen large developers will be, do this many low income units this year in these areas. You can build X many speculative units for rich people to play around with, but it's going to be a very small number, and the whole thing's going to be controlled. And then, tech was market based because market incentives and entrepreneurialism is what that sector requires to advance and grow, right? And they did allow that. The problem is there was a built-in catch-22 there, which is that, as we see in the US, these tech companies get to a certain scale and scope, they obtain political power. I mean, Google is tremendously politically powerful. Look at Meta. I mean, I don't know.
Well, the Chinese versions are copycats, right?
I don't know what effect Zuckerman's 400 million had in the Wisconsin general election in 2020, whatever. But these are very politically powerful companies. Google can shape opinions. Okay, so there's just no chance the Communist Party was going to allow that. They could not allow it. So China tech was a victim of its own success. Okay, it actually did grow. Now look, these companies were also great beneficiaries of the fact that China didn't allow Google and and Meta.
There was IP. Well, the condition was IP sharing, right? So like Facebook right. And Google said no, thank you.
yes, like every other industry in China, that was certainly part of it. But there are aspects of whether it's electronic payments or whatever that China really there were some advancements there, but again, like those companies were just at the point of obtaining scale and scope where they were going to start to be able to shape opinions in China. And I'm sorry, that is the purview of the propaganda ministry, right? So it just couldn't be allowed to continue. So, those companies are now being brought into the fold of the central planning apparatus. They won't be as dynamic, but they are cheap businesses. I think the problem is nothing works in debt deflation. Okay. value stocks are only going to get cheaper. Like nothing works in debt deflation, which is why, to bring it back to where we started, the Fed cuts it off, because it's not, debt deflation doesn't self-correct.
Well, governments hate it. They can't tax it either.
Yeah. So at some point, China is going to have a reckoning with this exchange rate, because the debt deflation process will just continue until they can't take it anymore. And where that point is, whether that point's in 3 months or 3 years, is basically dependent on the path of the US dollar and what the Fed does.
That was an excellent discussion. Brian, I want to thank you so much for your time. My listeners want to follow you on Twitter, X, or take a look at Macro Lens. How do they do so?
Yeah, I am at Brian Go Bosox, all one word, on Twitter. You can find me there. My DMs are open. Love to chat. Macro Lens is an institutional research service, but if any of the listeners would, like a free trial, just DM me on Twitter at Brian Go Bosox, all one word, and happy to chat.